Thank you for joining us today. Jamie, so we've got a couple of us here today. We've got Jamie Griggs, who's the marketing director for the Ladd Group at Cascade. Sotheby, she's put this together. Thank you very much. I've got Giancarlo Gatto, who is an exceptional lender. He's an institution here in Bend, and he's here to speak about interest rates and mortgage rates, in the mortgage industry, what's happening and how he feels about it here in 2022. And then I've got Steve LaCrosse, who is an exceptional broker here on our team. And we're each going to take a few of these points today and get after it. So Jamie, can you post that poll that we put out there earlier? I'd love to see kind of everyone's opinion on how they feel about real estate here in 2022.
Yeah, hopefully everyone can see that right now. We have about 58% of people saying the market will stay strong, prices go up. 8% saying market will soften, prices go down. 17% saying somewhere in between, and 17% saying they just don't know.
Great. Okay. And that's pretty much matching the sentiment of what we're getting when we're talking with our clients. So we've got a lot of good things to talk about. So I'm going to jump right into it. Excuse me, jumped ahead there. So first thing that I want to talk about is kind of where we stand, how we finished 2021, where we're going to 2022 as far as a leading indicator. So what I have up here is this is by a company called Showing Time. This measures number of showings that a home gets when it's on the market, the activity level. And what was really interesting is that the pandemic did not play out the way we originally thought in early 2020, where people would be afraid to go out and look at homes. 2020 was a record year for the amount of showings that we had. 2021 even went higher, so that it bested that. And what we're seeing is that's continuing to increase. And here we are a week into 2022, and we're seeing showings and activity far higher than we even did in 2021. So generally, showings are a leading indicator. When buyers are out looking, generally that's an offer 1-2 months down the road. And we're continuing to see that, increase as we go into 2022. And that's a leading indicator. And then the lagging indicator are the pending sales. And we're seeing that continue to climb as well. So at the very end of 2021, we saw a dip in the amount of showings that we have. This chart here is a 5-year chart of showings. And this really shows how elevated the interest is. It's about 15% more showings than we got anywhere in 2014, 15, 16, all the way through about early 2020 when the pandemic hit. And if you look at this chart, you can see that at the very beginning of 2020, it was starting to increase off of what was a fairly quiet year. 2019 was a more quiet year in real estate here in Bend, Oregon. Prices were flattening, showings were slowing down. It was feeling like kind of a soft plateau. It started to build in early 2020. The pandemic hit. Everything went quiet for that 2 to 3 month period. And then it's been absolute gangbusters since then. And what we predict is that this, given the indicators that we're seeing, is that pending sales are going to continue to climb here in early 2022. And we don't see anything, stopping that in the near term. The other thing that I want to talk about before I'm going to hand this over to Steve, he's going to talk about a few of these points, is home equity will continue to cause some movement in the market because the price appreciation that we've seen for the last about 11, 12 years in a row, the trough of that Great Recession and the housing correction was about 2011 or so, is that it's created a lot of positive equity in the home. This is a chart here that we put together, CoreLogic put it together, and it showed that nationwide we had a lot of equity growth, especially here in Oregon. The average homeowner saw about $66,000 of increased equity in their home from 2020 to 2021. What does that mean? One, it makes people feel like they have more net worth and they do other things, but we're going to start to see some movement in that. And I think I kind of put that into 3 tranches. When people have this much built up equity in their house, a lot of things happen. They either move up, they move out, or they move down. And so sometimes when they have this much equity, this might be the time where they sell their house. They, they want to downsize later in life. They want to move up. They're busting at the seams. They've got enough equity in there that a cash out refinance or a sale, they can then move up to the bigger home that they want. And then this is also a time where we see people move out of the market. This is the opportunity. They've been in Bend a long time. They have a lot of home built up equity in their home. And they say, this is a good time. I'm going to make that desert move or Hawaii move or whatever they want to do. So I think that this increased home equity is going to start to create a little bit more churn in the market than we've seen in the last number of years. And it kind of just allows people to make that next move. Steve, do you want to jump in here and talk a little bit about inventory?
Yep, absolutely. So this slide shows the supply of homes. We've talked about supply before, and it gets into months of inventory. The short definition is that's the amount of time it would take to work through all of the existing homes that we have on the market at the pace at which they're selling. So standard market, balanced market, buyers and sellers are evenly transacting. It's about 6 months. What we can see here is we're down about 25% year over year. Now, in any given year, we'll see those 25% fluctuations. Seasonally, there's a different supply of homes in December than there is in June. However, looking at the chart, we're going on 3 years now of decreased supply, decreased inventory, fewer choices for buyers. So a 25% drop from 2020 to 2021, a drop the year before that, and a drop the year before that. So how this will play out, goes back to what Brian was saying. If those pending sales are going up and the showings are going up, unless we have more and more people coming on and replenishing that supply, we're going to see this line continuing lower. Hopefully we can see some more balance and more people will make that decision, and we'll have some more options and potentially have some more new construction or other ways to replenish the supply so that buyers are able to have some options. But time will tell on this one. But one other thing that I will point out on this is when you start looking at different subsets of category of like a residential on a certain size lot, this gets as low as a half a month's worth of inventory for certain subsets of the market. So, different portions of the market are tighter than others, but this is showing a snapshot overall. So,
yeah, Steve, let me just jump in there. I think that what this brings up a good point is we've talked about this a lot in our webinars. A balanced market of forces between buyer and seller, when things are more balanced, is generally about 6 months of inventory. We haven't crossed that line in over 2 years, any time of the year. So even if we were to get a doubler of the amount of inventory on the market, we would still be under quote unquote a seller's market as far as the amount of inventory. So even if we get a little extra inventory with some forbearance or some foreclosure, because we're at the end of the forbearance that Giancarlo is going to talk about in a little bit here, we're still a long ways away from having it so that there's, buyer empowerment in this market. It's still very much a seller controlled market.
Absolutely. Yeah. And a couple of the trends in the next slide will help indicate as to why that will likely continue. So this next one, everyone's heard the news, lumber's gone up, steel's gone, everything costs more to do. And so this chart in particular really helps show the amount that it's gone up over the course. Again, you see fluctuations, these are commodities. Sometimes they're able to produce a little more, they're able to distribute a little bit more, but this, as you can see, this chart is straight up. So the three that are on here, aluminum, that was up 35% year over year. Lumber, which is the big one everyone hears about, was up 111%. And steel was up, 123%. So that's just the material end of it. Then you've got the labor. Everybody has heard the Great Resignation. Lots of people just reevaluating what they're doing and deciding to do different things, just like they're deciding to move to different places. And so what we end up with is every segment of that supply chain, the producers, the distributors, the transportation, the laborers on site that can install, every segment of it has diminished. And so that means the ones that are staying, they're doing more, they're getting paid more. And so both, we don't have a chart representing that labor cost, but both of them would look extremely similar to what we're seeing with these materials. So
go ahead. No, and the only thing I can add to that is a lot of people think that builder margins are wildly high. They think they have a 30% margin, et cetera. Historically, the average is between about 6 and 7% gross profit margin for builders. Maybe it's been a few percentage points higher. Maybe they got to double digit in the last number of years, but there's not a huge margin in there, for them to come down in if, I just don't see construction prices pulling back because there's only, given the cost of land, because we have such a limited land inventory here in Bend, and these labor costs and the material costs going through the roof, there's not much room for them to cut. So it's going to be, the construction costs, unfortunately, I don't think are going to come down. Even if we get a little pullback on these material costs, generally, once material costs go up, they get kind of sticky. They don't usually come back down to as far as they were. And we're seeing, even if they come down a little bit, the labor costs are absolutely, parabolic at this point. So it's going to be tough to see construction costs or new home prices, flattening or coming down in the near future.
Yep, absolutely. And actually, that next slide helps highlight the number of home starts that we've been seeing. So prior webinars, you can go back there on our website. We've talked through the number of home starts being underneath that 50-year average for, I don't know, it was like 11 or 12 years in a row, I think it was, that we've been under ever since, the late 2000s. Builders kind of pulled back a little bit and sat on the sidelines and and we didn't have the labor. And so we've been playing catch up on new construction starts for, over a decade now. But it's been increasing, it's slowly increasing each of the last few years. And these stats from the National Association of Home Builders show that up 13% in 2020, we were up 9% in 21. But the prediction for this year is to stay relatively flat. A big portion of that is very well construction costs. Now, this is nationwide. So, when we're looking at a local level, we do know that Bend has a number of larger developments. It's certainly in certain portions of town. You go into Southeast Bend and Northeast Bend, we've got some larger developments that are taking shape, and they're able to do things a little differently than, say, the smaller spec builder. But with construction costs going up like they have been, you're going to see a number of spec builders that aren't quite as willing to take that risk, to go out and assume the risk and the liability. Like Brian said, margins are small, and now they might even be smaller. And that's something that they might not be willing to do. And then by that same token, landowners, people who bought land over the last number of years, have been waiting to get into the market and build their house and make that move, are now finding that those build costs are up 50%, 100% in some cases based on where they bought the lot. And so now those people are sitting on the sidelines and going back into the resale market. So you have one extra buyer who we thought was going to build a house is now competing with everyone else for those resale homes. So for a number of reasons, it does look to probably be flat this year. Again, Bend will have some bigger development projects coming online that have been going through the entitlement and development process over the last number of years and are shovel and build ready now. And that really will just be determined by their ability to get materials and their ability to execute with the labor that they have. And so, yeah, Giancarlo, I'll turn this one over to you.
Yeah, so it's an easy one. What's going to happen with interest rates? Get out your crystal balls. I'm going to let everybody know exactly what's going to happen with mortgage interest rates. So the chart you see here projects anywhere from low threes in the beginning part of the year to high threes at the end of the year. It's honestly not much different than what we were showing on slides at the beginning of 2021. So, everybody kind of projected that we'd go up into the mid to high threes last year. And it never really happened. I mean, we hovered around that 3% mark for a good majority of the year. It seems like, and you'll see on the next slide, I'll stick with this one for a second, but you'll see that, these projections do feel like they are bearing out. And if you do want a personal kind of prognostication or analysis of it, my feeling of it is, kind of the beginning of last year, we thought we were going to turn the corner on the pandemic at some point during that year, and it never quite happened for various reasons. It seems like the markets are believing that this could be ushering in a new phase of the pandemic where the economy is kind of untouched or less touched than it was. So to me, this recent interest rate rise, and you'll see it on the next slide if you guys can push that forward.
Yeah, Giancarlo, could you just give I know it's asking a lot. Can you
Yeah.
kind of make the connection between the pandemic and these interest rates for our
Yeah.
listeners?
Yeah, so I mean, everything seems to be pandemic related in one way or another through some degree of separation. So, typically what we've seen throughout the pandemic is as the numbers rise and the fears over what's going to happen and the unknowns are there, new variant, when the pandemic started itself, that seemed to correlate directly to interest rates going down. As things got more comfortable, numbers went down, vaccines came out. It seemed like that correlated with interest rate rising. It also correlates with the Fed getting more comfortable and raising their interest rates and tapering their buying program. So that seems to be the corollary. What this just tells me, if I'm just looking at mortgage interest rates, is that the markets feel like we're going to turn the corner because of Omicron. The numbers will go down, immunity will go up, whatever that means. So, that's what it's kind of saying right now. You'll see on this chart, even when this slide was made, Fannie Mae, or this was actually Freddie Mac source data, was saying 3.2 was the average 30-year interest rate. That same metric is at 3.45 today. And I would say there's several metrics you can look at. I think the most real world has it at about 3.57. That takes into consideration different loan types, points, all that kind of stuff. So we're bottom line is we're solidly in the mid threes for a 30-year fixed rate mortgage. Again, that varies on the type of loan and down payment amounts and all that. But these kind of benchmarks that these stats are driven from, we're about a quarter of a point higher than what this chart even shows. So we're in that mid 3 range. This chart goes back to, I think, 2016. And even if you go back to 2010, we've kind of teetered from that like 3.5% to 5% mark throughout that range. Obviously, we got a good bit lower than that right at the outset of the pandemic, kind of lingered at that 3%, maybe just below, maybe just above for most of last year. And then really the end of the year, during the holidays and this first part of January, it's been a pretty steep increase into that mid 3 range. And so, we'll see what happens. That the next part is tough to predict. Been doing this a long time, and I feel like we've said this over and over. At 5%, can't imagine rates are going to get lower, and it sure enough goes lower. So never say never. We could be at 1.5% for all we know, but I think most likely projections have us gone into the mid 3s and almost to 4% this year. Now, I don't think, and Brian probably could speak to this, I mean, it obviously impacts payments with housing prices going up. People are borrowing more money. That's going to impact your overall payment. But we have had a healthy real estate market throughout the time when we've gone between that 3.5% to 5% range. I mean, it does make a difference, but it's not, I think, a crushing blow. But a lot of it has to do with the Fed. If they decide they can artificially keep rates a bit lower, at least try to. So we'll see what happens with that.
Giancarlo, how would you advise a buyer that's saying, hey, I missed out on my 3% loan. I don't want to pay a 3.6% loan. I missed my window. How do you see that 3.6 based in the context of history? Let's put it the last 15, 20 years. How would you advise them in that situation?
Yeah, you can't time the market. It's one of those things, especially for a primary residence. For an investment property, if you're an investor, you can look at it a little bit differently, but it's so hard to time it and know what's going to happen in 3, 4, 5 months in terms of interest rates. In terms of missing the window, historically, absolutely. I mean, you could see on this chart, it just goes back, 5 or 6 years. That trough there, we're not very far off that. And that is absolutely all-time lows. So if you put this chart even further back, the numbers are way higher. So we're still, even at 3.5%, people would have thought that was crazy cheap money, at basically any other point in time other than the last 3 or 4 years.
Plus, if we're going into an inflationary world, 3.5% is going to be viewed as below inflation or whatnot. It's going to be viewed kind of as free money. And it's hopefully lessens the sting a little bit for buyers, given the prices, and that we don't see any, we're not seeing lessening demand for the homes that are on the market.
Yeah, and one of the things, just to stick on the higher rates, and how it relates to the real estate markets, one of the things we're seeing, there was this huge ramp up in our industry to take advantage of these low rates and the refinance boom and all the purchases going on. So all these companies staffed up and really beefed up their operations. And so, what we're seeing with an increase in rates from our side is a definite decrease in refinances. Just that 3.5% mark, that takes a lot of people out of the mix to be able to refinance, to just lower their payment. They would need to take cash out or have some other purpose to make it make sense. So it's definitely slowing things up in the mortgage industry. And one of the things that we're seeing already is that it's starting to expand the access to credit a little bit. So by no means are we getting into crazy risky stuff, but when you can pick from any borrower, and borrowers are just calling in constantly, you're going to take the cream of the cream of the cream. And we've seen that this slowing down, they've opened up access in some areas and opened up some products that really make sense to help get buyers in. We're now able to do FHA, VA loans, and those offers actually have a chance to get accepted. So it is opening up credit access a bit. So I think that's one of the positives of a little bit higher rate environment.
Interesting.
So yeah, and then to talk to the forbearance slide that we're here, I've seen a lot, Steve and I were talking about, there's some, kind of, I don't want to say misinformation, but some misleading headlines that sometimes surrounds this. You can see this chart shows forbearances in total are below 1 million. There's some other metrics like the national delinquency rate, which measures loans that are 30 or more days past due. That has now declined for the 7th month in a row. That's at 3.8%. It's the lowest since 2020, October 2020. And then loans that are actually in the foreclosure process is 0.2%. So 0.2% of all existing loans. And that's the lowest since 1999. So those numbers are really, really low. I mean, some of the answers are obvious. Home equity is the obvious answer. Most people would just opt to sell the house, take the equity, cash out if they can't afford to make the mortgage payment and rent. So you don't have people that are underwater like you did in that last cycle. But strong job market is cited as another factor. And then, disciplined underwriting. This is something that really has not got a lot of headlines, but our mortgage standards after the last collapse of the mortgage markets, everything got really tightened up, and it really has not gone in the other direction again. I mean, underwriting standards have been pretty consistently sound for the last 10 years now. So very strong mortgages have been written, as opposed to the 10 years prior to that, when there were these no income, no asset, at negative amortization loans.
And Giancarlo, we're talking about this not to confuse people about forbearances and the CARES Act and all that, but this is really to alleviate the concerns or confusion that people have when they see those headlines as saying a foreclosure wave is coming when we get to the end of the pandemic because no one had to pay their mortgages during the pandemic, et cetera, et cetera. And that's really, I think it's disingenuous and confusing at best. And it's really not going to play out, because the amount of what we're seeing, basically we can get into the data and do a whole webinar on this, but there's not a foreclosure wave coming, period. Would you agree with that?
I totally agree. I just think with so much equity that they've gained, I mean, that just being the bottom line, they'll figure out one way or another where it makes sense, where you're not going to have this huge foreclosure wave. I would agree. And that's good context.
Yeah. So Steve, do you want to kind of take this and correlate it to kind of prices and what we're seeing?
Yeah, I will say you've asked G to predict mortgage rates, and now you're asking me to predict prices, which it's interesting.
I don't have to put my name on it.
It's interesting how that worked out. So yeah, I mean, everybody wants to know. Everyone sees a chart like this where it looks like home acceleration has peaked, which it has, and they think that means prices are going down. This just means that it's not accelerating quite as fast as it has each of the last months for the last year and a half or so. And so the $1 million question, what will prices be? How much appreciation will there be? Will there be a correction? Of course, we don't have the crystal ball, so we look to the experts. And the next slide goes with this and talks through what that expectation will be. We do expect prices to continue to appreciate.
Yeah, before we go to
expect-
that slide, can you
Yeah.
talk about what this slide means? This is simply the price over year appreciation, right?
Yeah, so each of these months, how much was it over that month a year ago? How much have prices appreciated year over year? And so what we're seeing is that, back in the summer at the peak, when there were 5, 10, in some cases more than that offers on each house, we were seeing cases where the appreciation from June of 2020 to June of 2021 was 20% higher. And then we see gradually, as we've gone towards the end of the year, that's starting to normalize a little bit, right? We would expect appreciation to continue, but not continue at that rate. And then, so this slide does talk about that. So if that were to continue to normalize, what does that look like for this year? And the expectations, looking across 7 different estimates, are about 5.5% appreciation, and that's nationwide. So again, we can talk about the local markets and the different subsectors of certain price categories and below median, above median. But overall, it answers the question of there's low supply, there's high demand, people especially coming to Bend, looking for places like this that allow them to have the flexibility. Yes, we don't see prices appreciating quite as much as they have in the last year or so, but we absolutely see it continuing.
Yeah, and there's not an expert out there that I can find that is predicting price depreciation in the housing market 2022.
Yeah.
Whether they're vested in the industry like National Association Realtors or not, like the Case Schiller, everybody's predicting that this is going to be a positive appreciation year for real estate. And it's hard to find data that or a good argument against it, unfortunately. For those who are waiting for the price correction, we're not seeing that this year.
Well, again, and it ultimately, we've said it before in our webinars, housing boils down to supply and demand. And when you look at the numbers, they're simply just out of alignment right now. So until that corrects, we're going to see continued appreciation.
And that really, comes to our final point. And this is more of just a point for concern. But this ties into it, that housing affordability is going to continue to be a problem, and it's going to continue to be a bigger problem going forward. And this was some stats that I just pulled from the National Association of Home Builders, and they had it broken down by state. And it was pretty shocking, and it's a major concern. And this is something that as a city, as a state, as a nation, we have to figure out our housing supply. No one wants growth, but what we're dealing with housing affordability right now, it's absolutely going to crush our businesses. It's going to crush the employees. Right now, there's 415,000 households in Oregon that can't afford a median price house. So, the income needed to afford a median price house right now in the state of Oregon is 102,000, and only 25% of Oregon families can afford to buy a median price house. These are statistics that we've never seen. So that says that 75% of Oregon families cannot afford a median price house. So this is an absolute crisis. And this is going to be something that it's going to take a long time to deal with. And no one dealt with it the last 10 years. During the recession, people, all the home builders stopped, all the developers stopped, and they never caught up. Since 2009, 2008, we've been below the 50-year historical average in the number of homes that are being built. We're short 5 million homes a year nationwide. And if we go to Bend alone, this is a tough metric. But from the calculations that I've been able to run, we've been short about 1,000 to 1,500 homes a year if we wanted to keep median price housing affordable for median income workers. And then we have this continued, run that from the pandemic and the in-migration and things like that. And so I don't see this getting any better. And this is going to be one of the major talking points that we need to figure out as a community. And I don't mean to end this on a negative point, but this really shows what a crisis we've got as far as as housing affordability. We in the industry, you know, we don't want these high prices. This doesn't serve anybody. But it's kind of the state of the world right now. And seeing this stat that only 1 out of 4 families can afford to buy medium price houses is pretty shocking. But with that, Jamie, do you have any questions that have popped up either in the chat or the Q&A before we go? I see one from Neil, and he's saying, can you comment on the construction pipeline and new housing if there's certain prices that will have higher or lower demand? Yeah, so I'm not sure, Steve, if you want to take a crack at that. We're seeing demand across the board for locals and working class families. There is absolutely there's a lack of supply. In last check in all of Bend, there was one home under $500,000. Was that? I think that was accurate.
Yeah.
And so the demand on that is going to continue to be through the roof. The higher end luxury homes are a little bit more seasonal, a little bit more equities market dependent, a little bit depend on tourism and weather and no bachelor and things like that. But I would say probably everything under median price has the strongest demand, and the builders are doing their best to supply that. Polish Homes, Hayden Homes, et cetera. But I was just meeting with someone from Hayden today, and the biggest thing for them is land supply. And what they're actually, Central Oregon is becoming a smaller and smaller portion of their portfolio because they can't get enough readily developable land out in front of them at a price point that makes sense for them. And so they're building more in Spokane and Meridian, Idaho, and Tri-Cities, et cetera, than they are here just because of the land issue. So I think, it's going to be tough for them to meet, but we do have a fair amount of inventory coming on in that range.
One little point that I'll make on top of that as well is when that inventory does come on, we have seen builders waiting further in the build process to get their homes on the market. Previously, they might get it on a little bit earlier, try to take advantage of some price appreciation, but with timelines being delayed and costs jumping around all over the place, we've seen builders waiting until it gets closer to completion so that they know what the product is that they're going to be able to deliver, what their price looks like, what their margins look like, and then also that they can live up to that time frame that they set forth. So that is that other factor of, you might see a lot of construction going on around town that's not accessible and not available yet, just because they do have to make sure that they're listing it and putting it out there at a time when they know they can deliver at that price and that time frame.
Yeah, okay. I'm looking in here in the chat as well. There's some questions in here. What percentage of families already have a home of some sort? That's a good point. Because a lot of these people already vested, they are in their home. What percentage of the population are actively looking for a home? That's interesting. I don't have that at hand. But what we are seeing, if this helps lend color to it, the majority of our buyers that we're working with right now are out of market. It's still in migration that is driving the majority of the buyer demand. And so that's an interesting stat. I'll get back to you on that one. That'll be something that I'll come up with again. But you're right, not everyone in the market's looking for a home. And thankfully, a lot of people already are vested in a home and they can move within it and stay in that property ladder, moving up, down, sideways. But especially for younger people or people coming from less expensive markets, it's going to be really tough to get your toes in this market. And then there's another one about urban growth boundary. We've done webinars on the urban growth boundary in the past, and that's something we want to take a crack at again. That's a whole can of worms. But they're using up the land that was brought in with the last urban growth boundary, which was approved in 2017, 16, something like that. And I do know that the city is now talking about putting together the next round, but these are things that take a decade at a time. So it's going to be a little bit before we get another urban growth boundary. These Oregon land use laws are not quick to adapt to short-term cycles, and we're at a crisis point. But the city is doing some things, and they just did a special exception. They got the state to allow them to bring in some land that had affordable housing, things like that. But let's take a crack at that with a future webinar, and we'll jump on that next time.
And then it looks like another one just came in about, can you speak about the possibility of demand decreasing and a more leveling off? Because with home equity as high as it is, sellers looking to cash in, and which would then create more inventory. That's absolutely true. What we have seen, the majority of our sales are people relocating out of Bend. We're not seeing as many people who are staying local, selling their house. And I think, you know, a lot of our clients, they ask constantly, what can I get for my house? And the answer is that number's higher than what they originally thought, but they want to stay in Bend and they don't have the replacement that is, unless they're really looking to upsize or downsize or change something dramatic about what they're doing, putting their house on the market, getting a bigger number for it, they can't do as much with that locally. And so we don't see as much of that churn, you know, as you would expect. So the majority of the sellers are ones that are either shifting a big category about what they're living in, where they're living, or moving out of Bend altogether. And then Giancarlo, you can jump in with this, but with interest rates ticking up, how does that bite into the buying power of some potential buyers? I mean, I know how I feel on the real estate sales side of it, but what do you see?
Yeah, I mean, obviously, like it goes up exponentially, and as home prices increase, that number just compounds even more. You know, if the interest rates go up, you know, it's tough to say because there's just so much demand. And I was going to ask you guys, I see, at least in my practice, that there's more people moving in from out of town than cashing out and moving out because, you know, at the end of the day, this is a more desirable place to live to most people when all things considered. So a lot of my clients from Seattle, Portland, San Francisco, wherever the case may be, expanding further across the country now, the longer I'm here, I feel like I see Texas and East Coast and everything. But I still feel like the vibe is they're looking for a reason to move here because of the quality of life in comparison to where they're coming from. And when my clients start to look at, you know, other places to live, I feel like they start to circle back here once they really dig in on their home search.
Yeah, we're seeing a smaller percentage go, you know, snowbird to warm places that we simply can't compete.
Yeah.
But I don't think it's enough to really meet that inventory crisis that we have. So there will be some softening demand with some people leaving the market. But for every person that's leaving, I think we've got two waiting to get in. And so I just don't think it's going to add that inventory, but it is creating some churn. And the other thing about the uptick in the interest rates biting into the buying power of buyers, I think that is accurate. And I think it's going to decrease their buying power. And I think it'll help flatten this price appreciation curve that we've had. I've been hoping for a flattening of that for years now. And I think that's going to be, you know, as these interest rates go up and affordability goes down, it's going to lay down that curve. And that's why, you know, we're not predicting these huge double-digit price appreciation going forward nationwide. But it definitely plays into it. I just, once again, you know, it's a supply and demand. And when we have 1/5 the amount of homes that we need on the market, it's hard to talk about the subtleties of interest rate increases on the buying power to flatten prices when we have such a shortage of homes. Here's another one, Bozeman. Well, Bend isn't Bozeman. What's the possibility if people don't find Bend to Bozeman? They're going to head to Bozeman. There are people doing that. My brother is a developer and real estate agent in Bozeman, and they're going gangbusters. Unfortunately, the median price of all these markets is coming up. Bend's not alone in our high prices. The median price in Boise, Idaho right now is over $500,000. So while Bend is unfortunately in the upper sixes, which is painful, when you look at a large metro area that has, you know, suburbs and for 20 miles, and they're only $100,000 less in a median price, it's not necessarily a cheap buy down anymore. Bozeman's the same. I mean, there's a lot of pretty ordinary homes in downtown Bozeman that are selling at 800, a million, million two. So I don't unfortunately think that Bozeman is an easy out. And someone's saying, hey, what was the question? I didn't explain it well. They were saying if Bend becomes prohibitively expensive, won't they just go elsewhere? Unfortunately, there's not a lot of great elsewhere. A lot of people come and scratch their head and they go try on all the usual suspects from Bellingham to San Luis Obispo to Bozeman to you know, Salida, Colorado, to, you know, to Durango, et cetera. And unfortunately, they're all dealing with the limited inventory crisis that we're dealing with. And there's not a cheap version of a bend out there where people are saying, hey, you've gotten too expensive, I'm going elsewhere. So.
Oh, so I think, Brian, I think what part of what he's saying about the question is, what if some of the transplants don't find bend to their liking? So I guess maybe
and they leave.
to the thought of like move from California, spend their first winter here, and then decide that it's about 3 months too long.
We see a little bit of that.
Yeah, there's some of it.
That nothing's changed with that. You know, we see more of that when it's a Southern California buyer than it is a Northern California buyer. You know, I think it's a little shocking to not be able to wear flip-flops 11 months a year, but we always see a little bit of churn in expectations. And after our big winter of what was it, 2017, where we had snow on the ground for 4 months, we did see more turnover in the spring. So you're right. As these new buyers come in, there's going to be some turnover, but they're liking it here. And when they go back and visit, you know, the big metro area they came from, they usually come back saying, yeah, it's a little cold, but my gosh, do I have it good here. So unfortunately, we don't see a ton of turnover on that.
Well, can I just say one thing on that too, that there was a big discussion about what happens when companies start calling their employees back. What happens when, you know, they don't allow them to live remotely, or they give them a less than salary for living somewhere where it's a little bit cheaper than where they are. And, you know, we were thinking this could be a real thing, and it still could be. But what we've seen is that people just go, okay, I'm done. I'm going to go do something else. And I'm going to start up my own company. So yeah, there are some things that could affect people's desire to stay here, but overall it's such a small percentage, and people are putting values on where they are and what they're doing. And yeah, there will be some inward and outward migration on this, but overall it's not enough to chip away at what's going on, which, you know, we've talked about before, how many millennials are entering the key home buying years. And, you know, there's just a very large supply that's not going to outweigh those few that are unsatisfied.
You touched on it, Stephen. We could probably do a whole webinar on this, but like, it is being market specific. That tipping point of remote work, you know, 10 years ago, people worked here remotely, but it was kind of like they worked for the company for 10 years and the company allowed them to work remotely, and that they crossed their fingers because if that situation ended, they were going to have to move. And there was some hesitancy to buy and really plant here, because if it wasn't that job, there wasn't anything else. The industry here wasn't competitive with the salaries and whatnot. But I mean, I see that on the daily. The remote work is just kind of locked in. We need to get letters from an employer if someone's buying a house here as a primary residence to say that they are aware and they can work here remotely with no kind of callback or anything in place, and that it's not a temporary situation, I guess I should say. And that is the norm right now. And that factor, in my opinion, has helped drive this market, because that, and even beyond that, you can live here and find a job working remote in a major city, even if you lose the remote job that you had. So that sense of security is a huge flip from where it was 10 years ago, where it was a huge sense of insecurity with a lot of people who work remotely.
Yeah, so sorry about that, James. I misread that when I was trying to read it out of the corner of my eye, but hopefully that addressed that question. But I don't want to get too long in the tooth. We've taken a lot of your time this evening, and I thank you for joining us. Thank you, Giancarlo. Thank you, Steve. Thank you, Jamie. And thank you all for taking your time to talk about real estate. We're always here for you if you want to connect. And I've taken some notes here, and we're going to take a crack at some of these urban growth boundaries and, you know, amount of inventory that's kind of shadow inventory that's going to come out in the next few years. And we'll address that head on in a future webinar. But we've got a history of all of our webinars on our website under the resources tab. And then if you go to our YouTube page, the Ladd Group YouTube page, we've got a lot of these that have discussed all these subjects. We've been doing about every 1 or 2 months for the last couple of years. We've got a lot of good data there for you as well. And it looks like Jamie just put it in the chat. But anyways, thank you so much. Feel free to pass this along. We're going to send you the recording to friends and family, and we appreciate your trust. Take care.